RMC is a world-class asset management shop focusing in commercial real estate, specifically the office space. I consider it an best of breed. And today, office is a very intriguing topic that I think all investors need to be considering. But with that said, Mike, can you give us a little background on yourself and tell us a little bit about Group RMC before, like, I start to drill down into, why people should be looking at it?
Yeah, thanks, Mike. And honestly, thanks a lot for having me over today. And thank you guys for joining. Group RMC is a very old school family office co-investment group. Essentially, we're a bunch of families that get together to buy very high income producing real estate, particularly in the Midwest and the Southeast. I mean, long story short, now we're pretty much families from all over the world. So we have the structures accommodated, Cayman structures, US blockers, and onshore, so that wherever you are, however you want to invest, there's a way to do it. And we're about, a couple of 100 families now. And together, we're some of the largest landlords in a handful of cities in the United States. So it started off really, really small, during the savings and loans crisis in the 80s, and during the Quebec referendum in Canada, when we almost split from the rest of Canada in the 90s. And then after 2008, we went back into the United States. And now with the pandemic, we're also finding our fourth once in a decade opportunity buying real estate. And it grew into what is now a handful of families being, I would say, the largest landlords in Kansas City. We're now one of the largest landlords in Columbus, Ohio. We're the largest, I think, now in Memphis, one of the largest in Indianapolis, the third largest suburban office landlords in the suburbs of Chicago. We have about $2.5 billion in real estate, and it represents around 21 million square feet of buildings. Yeah, thank you.
So being a real estate families, what would you say is the number one rule when looking at new investments? And I'm going to turn down the sound over here for a second.
Okay. Number one rule, I mean, you got to make money on the buy. It's really all about the basis. And I think this applies to pretty much any asset class, not just real estate. A lesson that permeates through what we do is the following. It's usually what dictates the pricing of an asset isn't necessarily its intrinsic value, what it's really worth. It's the flows of funds, the bidding wars that bring up pricing way beyond what something is really worth or its intrinsic value. And I think it's very important to make money on the buy, and it's all about the basis. So when you buy something for at or below intrinsic value, which is usually where the flows of funds aren't or the bidding wars aren't, not only are you lowering your risk, because when you're buying something for really cheap, your yields as a percentage are significantly higher. So you're lowering your risk because your break-even occupancy is significantly lower. You can afford to lose a lot of tenants and be still in the black versus others who overpaid for assets. They lose a few tenants and they're in the red. And in bad times, that means you could be very cash flow positive and continue distributions and even undercut competition and steal tenants. And in good times, because you're buying something for very cheap, your yields are just higher. So you're just making a lot more money and you're making much more distributions. So the number one rule of investing, I would say to all asset classes, is try to make money on the buy. Buy something below the intrinsic value, or like Warren Buffett would say, it's hard to go wrong when you buy a dollar for less than $1. And that's what it's all about.
So replacement costs.
Replacement costs is one big thing, because too often we talk about the demand side of the equation and we forget the supply side of the equation. Demand side is the bidding wars, is the momentum, it's everyone getting excited. But the supply side of the equation is the risk aversion, which you just mentioned is the replacement cost is a key metric on the supply side. It's, say you're buying something for $100 a square foot, right? And if you're buying something at 50% discount to replacement cost, just to replace that asset, or a new contractor building a new asset right next to you, similar asset, similar land, he would, if you're at 50% discount replacement cost and you paid $100 a square foot, his basis would be $200 a square foot, right? And that's really important, because not only you're able to undercut a contractor, but say the rents that you're charging to your tenants is $20 a square foot. At his basis, it would have to be 30 or $35 a square foot. And the reality is, a lot of markets won't absorb or accept $35 a square foot. So when you're talking about replacement cost, What's really important is when you're buying, at big discounts to replacement costs, what you're essentially doing is creating barriers to entry from new competition. So again, there's no cranes. If you're buying it that much cheaper, it doesn't make sense for someone to come compete with you because they can't. So you're in a situation where no one's building around you. There's no cranes. And if ever they do, you can start charging higher rent too. So your margins are higher in good times. And in bad times, you can actually undercut the competitor who, built something for twice the price that you paid. So you're absolutely right. That's a huge thing. So it's not just buying below the intrinsic value or below appraisal value. It's also buying below the material and labor cost of the asset. So you kind of, become very defensive at that point.
So I don't want anyone to think that I'm biased here. So let's talk about what everybody's been thinking with regards to office. How has the macro factors for work from home impacted the office space?
Yeah. At the size we are now, as I was mentioning, about 21 million square feet, we're to start, I guess we're to size right now as a private group of pretty much a mid-sized publicly listed REIT. And so in and of itself, with, the 200 buildings that we have across the 12 different states and all that, I think we have a good data point. And I mean, I can go a long time on this, but, truthfully, when it first happened, we've never seen this either. So we were learning as well as we're going. I'll just skip to the end. We have about 98 to 99% rental collection rate. So we're collecting almost 100% of our rent across our portfolio. Our occupancy is pretty much the same as it was before the pandemic. In real estate, if you have the correct kind of mortgages, you're actually paying down your debt as you go along. So we also have now less debt than we ever had. And so that means that we have more cash and we continue to pay distribution. So that's what happened. But, if you dig a little bit deeper and why that happened, well, there's a dichotomy or a huge dislocation between the coasts, at the beginning at least, where there's a lot more bigger, more dense areas. People are squeezed together, going into metros or trains, and the gateway markets suffered a lot more at the beginning, at least, than non-gateway markets where we operate. We're really in the Midwest and Southeast. There's less density, lower taxes, so there's not that much public transportation. The buildings aren't as tall. In the office space, because rental rates are so much cheaper, people tend to have bigger floor plates. And so non-gateway markets or suburban office actually fared pretty much better, I would say, at least in the beginning. Now you've seen some recovery in all kinds of locations. But what it did do is, for those who were well capitalized and for those who are receiving good distributions, we were in a position of not being on a defense, but actually capitalizing on the situation, going on the offense. By not being over-levered, by not taking too much risk. When this whole thing happened, we had the firepower to take advantage of what I think is, and it's hard to argue this, but 2020's or this decade's opportunity buying real estate. And so before the pandemic happened, it was actually getting harder and harder to find good pricing. We were buying less deals, we're very strict on what we buy. But when the pandemic happened, there was, at first, debt markets seized up, and then office was definitely not in the narrative. So we bought about $500 million of real estate. We were extremely active. We bought from all kinds of institutions who actually need to, some cases needed to get out, or some who may have been over-levered. And I think that we perhaps bought the best deals we've ever bought in our entire history.
That's interesting. That factors right back into, it's on the buy where you make your money, right?
That's absolutely
right.
Absolutely.
So multifamily prices are high, right?
Mm-hmm.
Hospitality prices are high. Industrial prices are high. For people to have the vision and the wherewithal in office, what are you seeing for deals?
Yeah. So what you're seeing is, let me take a step back and talk about cap rates. Many of you may be familiar with it and many might not, because it's a very real estate centric term. It's essentially your yield before putting on a mortgage, right? And so everyone talks about cap rates. Are you buying a 5% cap rate or 10% cap rate? And those who are a bit more mathematically inclined, the cap rate is as simple as two things. You have a numerator and a denominator. It's your NOI, your net operating income, divided by your purchase price. So say you're making 100 grand of NOI, that's your net operating income, divided by, something that you bought all cash for $1 million, 100 divided by $1 million, that's 10%, right? That's what you get a 10 cap. We haven't seen 10 caps. Many people haven't seen 10 caps in over a decade. And that's what we're looking for. We're looking for anything between 8 and 10% cap rates. So you won't find that in all the asset classes that you just mentioned. We've been finding it in office with long weighted average lease terms. So the beauty of the cap rate is that once you put a mortgage, you start getting a lot of income. And if you're looking into real estate for income and to get those nice quarterly distributions, or the mailbox money that everyone talks about, or the passive cash flow, this is a really, really good way of doing it. So imagine you're essentially a landlord to corporate America. You have tenants like Microsoft, MasterCard, Oracle, Daewoo, PNC Bank, United Health, beautiful tenants. And you're receiving, because you're buying things at a discount, your yield is higher. So you're receiving really high percentage of yield and returns of actual cash distributions in your bank. That's what we're looking for. There's really two ways I see it of most people making money in real estate. You have the capital appreciation. So invest in a hot market, hope that it costs a little bit more, or buy something for really cheap and receive distributions. I like income. It's something real. It's something in my bank account. I like it. And it's not necessarily predicated on a sale. Oftentimes you hear people say, this is classic, but you got to buy low and sell high. I'm thinking what's happening right now in the coastal markets or the hot markets, people are buying high and trying to sell higher. That's fine. You're still making money. But another way of saying it in a much more crude way is it's like saying, you're buying a Honda Civic for $100,000 and then you sold it for $200,000. Look, that's a good thing. You made $100,000, but you bought a Honda Civic for $100,000. You know how dangerous that could have been? What if the music stopped? What if you didn't get that accretion? What if there's not some guy on the other side willing to buy a Honda Civic for $200,000? You would have been stuck with a Honda Civic at $100,000. So what we're looking at doing, going back to the basics, is when you're buying a dollar for less than $1, you got to get that Honda Civic for $12,000. So no matter what happens, you bought for below the value and you'll be okay. And so, you can make money on the capital appreciation, which I'm saying we still do. But if you're making money on the buy, your yields are so high, you're getting paid to just own real estate.
So go into that into a little more detail and give us an example of a property that you have purchased since COVID came. What is the occupancy rate? What does it look like? What were the cap rates? How are you repositioning the assets? What's the long-term plan?
So I'll give two examples. One case, we bought the Bank of America Tower in Jacksonville, which
welcome to Florida.
Thanks, man.
Welcome to Florida.
We've been circling the market for many, many years, and we couldn't strike at the right price until now. And so we're really happy to own the Bank of America Tower. And we got that for about $108 per square foot. Just to give you an idea what that means, to put it in perspective, it's one of the nicest buildings in Jacksonville, Florida. It's by the water. It's 42 stories tall. It's part of the skyline. It's kind of cool to own a little bit of the skyline. And I would say to rebuild this thing would probably cost $400 a square foot.
Wow.
And you're getting it for 108.
Wow.
So
cost is
yeah,
4x.
yeah. Well, when you think about it, we always hear it. It's not new to anyone who's listening to this. Materials have become super expensive.
Right.
There's a labor shortage, and good labor is, and labor in commercial real estate is requires special licensing too, so it's even more expensive. Land has become more expensive, and so building is very, very expensive. So when you're buying something at a fraction of the replacement cost, or like an 80% discount to the cost of placing the asset, you'll be okay. And so we're really excited about that. We have another deal that's live right now that you guys saw the video of. This is interesting because it's about 1.3 million square feet. I'm really excited because the metrics, if I were to sum it up, it's two things that usually you don't see together at all. You have a 10% cap rate, the legendary 10% cap rate, but at 73% occupied. This is for class A or B plus assets, nice assets, the Chase Tower in Milwaukee and a bunch of assets in the suburbs of Illinois, very nice suburbs of Illinois. And so why I'm saying that is because you're getting an immediate yield right away. And we're paying out big distributions starting in Q1 of next year. And then on top of that,
what are those distributions? I've seen something quick.
So we're going to pay 6% starting a year, paid out quarterly, with the anticipation of growing that much more because the yields are double digits. So the yield is like 12%, but we're going to pay out 6% because we want to be conservative. You need to keep a lot of cash because cash is a lot like oxygen. Warren Buffett says, cash is a lot like oxygen. You don't think about it until you run out, and that's all you think about. And so we want to be very well capitalized. It's the way to own real estate, especially commercial real estate, which is particularly capital intensive. So we're going to pay out 6%, but this thing's a 10% unlevered cash yield. It's a 10 cap. But usually to get a 10 cap, maybe if you were 100% occupied, you get 10 cap. But this particular deal, we're at 73% occupied. So what that means is that you're at 10% with upside. You just lease it up to market occupancy of 85, and your 10 cap becomes 12 cap, which people haven't seen, I would say, maybe in their lifetimes, especially in this quality of assets.
So getting back to the buy, you guys are buying at the right prices right now.
Yeah, and the buying at the right price is so important because not only are your returns better, but your risk is lower too.
Have you noticed a shift in investor like appetite for office right now?
It's starting actually. Some institutions right now are allocating to office, which is good and bad. It's good because it's nice to know that there's other people who believe in the market as well, and we're getting past this whole COVID thing. It kind of it's bittersweet because that means more competition in our market, which would bring up the pricing of our assets. So back to what I was saying, usually what dictates the pricing of an asset isn't its intrinsic value, but it's the flows of funds. So if the institutions start coming into our markets and bidding up our pricing, then we'll have a harder time to find the 10 caps.
So let's digress a little into some social debate. I'm sure you're talking to a lot of your tenants who own businesses, and the debate between labor and corporate America. Do the companies want the employees back in the office? What's the deal there?
Yeah, it's a good question. What I think, and from interviewing a lot of business owners, is that we're going to embrace a hybrid model where people have flexibility and they can feel like human beings and go to the office because they would be short selling themselves if they think that they don't bring value by being together with others. At the same time, flexibility is great. So I think the hybrid work structure is going to be good. Going to the office is extremely important for culture. I mean, think about it. If you don't see your employees ever, it's very hard to keep any kind of level of corporate culture. And I bring it back to also training. I always remember Roger. He's not here anymore, but Roger was my first boss. And we stayed up until 1 or 2 in the morning working in Excel. I was in accounting and my background was accounting, but I didn't know Excel. My first job, I was kind of panicking. Didn't know VLOOKUPs or pivot tables or HLOOKUPs or how to do models. He stayed up with me and trained me really, really well. I don't think Roger would have cared to stay until 1 in the morning over Zoom with me. They told me to figure it out. So I think for training, for corporate culture, for camaraderie, I think people are going to stay together, but I think for flexibility, we're going to have a hybrid model. And you know what? The collaborative workspace takes a lot of space. So if you look at our portfolio, I told you that our occupancy is down. It's actually quite flat throughout the pandemic. It's because the office space is looking a little different. Boardrooms take a lot of space. Breakout rooms take a lot of space. And if you want to be a little bit less social distance in the office, you need a little bit more space. So I think that's what it's going to look like. But I think everyone's different. Every company's a little bit different. In the Midwest, rent is much cheaper than in Manhattan or in Miami, right? And so for a CFO to take a step back and make a decision to never see his employees when his rent is only $20 a square foot is very different than for a CFO to make the same decision to never see his employees when his rent is $90 a square foot.
Right.
$20 a square foot is a very affordable way to see people.
What is Jamie Dimon at JP Morgan saying, and what implication does his, let's say, lead have on the rest of the banking space?
Well, what happened there is that he realized, if I'm reading this correct, he realized that maybe not him in particular, but a lot of businesses were losing business because their salespeople weren't out there meeting their clients in person. They were hoping to do business from home, whereas others were a little bit hungrier, were meeting their clients in person. And so that's how you really build a relationship. It's not just clicking off and the Zoom is over. It's really what happens after, before, and kind of talk about the family and the kids. And it's a little bit of a different connection. I don't have to tell anyone or sell anyone on this, but it really is. And I think when the cutthroat world of investment banking, and you're trying to get those big contracts and those big, you want to get those big clients for the IPOs and all, you have to be, as competitive as possible. And sometimes being closer, relationship based is very important. I think Jamie he sees that.
He's saying you come back to the office, right? And the other banks are following suit.
Absolutely. And I was trying to be, I guess, a little bit more soft around it, but I think that's the reason why.
Right.
You're trying to outdo the next guy. So How are you going to be closer to your clients if you're not going to be present?
And then there's also, we're paying you a salary, and for that salary, we expect you to show up at the office and work, specific hours and do all that,
Yeah.
what you're being paid for,
Yeah, absolutely.
right?
I mean, otherwise, I mean, why hire someone in New York? Why not hire someone in Albania?
So I think people
You
are
know?
realizing that the office story isn't going anywhere.
That's right. I think downtown core is needed. I mean, we're not downtown in many cases. In some cases we are, but I think the economy needs it. The livelihood of many businesses downtown need the employees to get back to CBD, central business districts, and all that. And I think that we do at one point. We are a social creature. Sam Zell says it all the time. You can't motivate by modem. And I think he's right. I think he's right. So I think embracing a hybrid structure is really the right way forward. Yeah. I see it with my team as well. At one point, we get kind of lonely and maybe stressed out and just get a bunch of emails in our inboxes of people asking each other to do things. It's a little bit different when you knock on someone's door and say, "Hey, do you have a minute?"
So what do you think of Art Basel so far?
It's pretty wild. It's pretty wild. In Montreal, we canceled the F1, so I didn't see anything wild for a long time. And it's pretty amazing to come here and see the energy that Florida and Miami has. It's invigorating, really, and it's liberating. I would have to say, to just see people outside having fun, getting together, respecting each other. Whereas there's no, it's really different in Montreal.
So if somebody's interested in investing in RMC and wants to do one of your world famous due diligence tours,
Mhm.
and they're
Yeah.
qualified to do so,
Mhm.
who should they reach out to?
They can reach out to you or to myself. I know on the video there was Lisa Ansel's email as well. We're a whole group, or reach out to us on LinkedIn. We'd be very happy to make more friends and do good deals together.
All right, we're
Yeah.
out of time.
Yeah.
It's great to have you.
Hey,
here
thanks a
today.
lot. Thanks
Thank
a
you
lot,
for
Michael.
coming in.
Really appreciate it.
And, hopefully this is the beginning of many. By the way, I just want to plug really quickly for those of you that are local. Group RMC is opening up a Florida office in Aventura. So hopefully when you get a chance in 2022, you can stop by, visit their new offices.